Good afternoon. Welcome everyone. I'm delighted to have you all here in my channel today. My name is Oddy Medrian. I am MBA student of IPMI International Business School, Indonesia. Today, I would like to share with you the key takeaways on corporate finance class lecture by our distinguished professor, Sembel. In corporate finance class, we learn about several courses. Here are the content. Number 1, Introduction to Financial Management. Number 2, Capital Budgeting. Number 3, Analysis of Securities and Portfolio Investment. Number 4, Capital Structure and Dividend Policy. Number 5, Fraud Risk Management and Corporate Restructuring. Number 6, International Finance. And number 7, Event Analysis and Portfolio Performance Evaluation. What is the goal of financial management? It's an optimal orchestration of internal and external financial resources towards significant and sustainability value creation. To ease us to understand financial management, here we have a financial management mind mapping. It's integrated, practical, and intellectual satisfying. We start with the number 1, outside-in perspective. An outside-in perspective in the context of corporate finance refers to adopting an external viewpoint when analyzing financial decisions and strategies of a company, instead of solely focusing on internal financial metrics and data. An outside-in perspective takes into consideration the broader market dynamic, industry trend, and the impact of external factors of the company financial performance. When we are approaching corporate finance from the outside-in perspective, several key elements come into play, such as number 1, market analysis, number 2, industry and economic trend, number 3, stakeholder expectation, number 4, risk management, number 5, competitor analysis, and the last one, number 6, global factors. We continue to number 2, inside-out perspective. An inside-out perspective in the context of corporate finance refers to the approaching financial decision and strategies from an internal viewpoint. It means focusing primarily on the company's internal financial data, resources, and capabilities to analyze and make financial decisions. When adopting an inside-out perspective in corporate finance, several key elements come into play. Number 1, financial statement analysis. Number 2, budgeting and forecasting. Number 3, cost management. Number 4, internal financial metric. Number 5, internal resources allocation. And number 6, operational efficiency. What is capital budgeting? Capital budgeting is a critical process in corporate finance that involves evaluating and making investment decisions in long-term projects or assets. It helps companies to determine which investment opportunities are worth pursuing and how to allocate their financial resources effectively to maximize return and shareholder value. There are key components and concepts of capital budgeting, which include the first one, project identification. Number 2, estimation of cash flows. Number 3, time value of money. Number 4, capital budgeting technique. Number 5, decision making. Number 6, capital ratios. Number 7, risk assessment. And the last one, post-investment review. In corporate finance class, we also learn about financial shenanigans. Financial shenanigans, also known as accounting shenanigans or financial manipulation, refer to deceptive or unethical practices used by individuals or companies to present financial information in misleading or fraudulent manner. These practices can create the illusion of better financial performance, stronger balance sheets, or improved cash flow, leading to false perception of the company's health and value. Here are the unusual activities that might consider and fall into financial shenanigans. The first one, recording revenue too soon. Number 2, recording bogus revenue. Number 3, boosting income with one-time gains. Number 4, shifting current expenses to a later or earlier period. Number 5, failing to disclose all liabilities. Number 6, shifting current income to a later period. And number 7, shifting future expenses into the current period. According to Prof. He is one of the world's most popular business advisors. There are 5 business essentials. Number 1 is cash. Number 2, profit margin. Number 3, velocity. Number 4, growth. And number 5, customer focus. In this corporate finance class, we also learn about dividend policy. Dividend policy in corporate finance refers to the set of decisions and practices that a company follows regarding the distribution of profits to its shareholders in the form of dividends. The dividend policy outlines how much of the company earning will be distributed as dividend and how much will be retained for reinvestment in the business. Company pay dividends for several reasons, each of which serve specific purposes and benefits different stakeholders. Number 1, rewarding shareholders. Number 2, attracting investor. Number 3, signaling financial health. Number 4, building investor confidence. Number 5, mitigating agency costs. Number 6, tax advantages. Number 7, stimulating investment. And the last one, complying with legal and contractual obligations. Now we continue to business ethics. Business ethics in corporate finance refers to the application of ethical principles and moral values in financial decision-making and practices within a company or organization. It involves conducting financial activities with integrity, transparency, and accountability while considering the impact of financial decisions on stakeholders, the environment, and society as a whole. Some key aspects of business ethics in corporate finance includes: the first one, transparency and disclosure. Number 2 is avoiding conflict of interest. Number 3, fair financial reporting. Number 4, responsibility to stakeholders. And number 5, the last one, environmental and social responsibility. In regard to this ethics, we also learn about principal-agent problem. What is principal-agent problem? Is a fundamental concept in corporate finance and economics that arises when one party, known as the principal, delegates decision-making authority to another party, known as the agent, to act on their behalf. The principal-agent relationship is prevalent in various business settings, including the relationship between shareholders as principal and company management as an agent, or between company owners or higher executive. Here are the things represent principal-agent problem. There are conflict of interest, asymmetric info, and moral hazard. Key aspects of the principal-agent problem include: the first one, information asymmetry. Second one, agency cost. The third one, moral hazard. The fourth one, adverse selection. The fifth one, incentive alignment. And the sixth one, corporate governance. To promote this business ethics, we have some initiative that we have to do. The first one, compliance with laws and regulation. Then we also have a risk management. We also have ethical investment decision, and we also have ethical leadership. In order to achieve good corporate governance principle, there are 5 things that we have to do. We call it tarif. T represent as transparency. A represent as accountability. R represent as responsibility. I represent as independency, and F represent as fairness. In this class, we also learn about the 4 cornerstones. The 4 cornerstones of corporate finance refer to the core principle and concept that serve as the foundation for the financial decision-making and analysis within a company. This principle help guide financial managers in their pursuit of maximizing shareholder value and achieving the company's strategic goals. The 4 cornerstones are investment decision, financial decision, risk management, and shareholder value. Then we continue to the efficient market hypothesis. The efficient market hypothesis is a fundamental concept in corporate finance and investment theory. It posits that financial markets are efficient, meaning that market prices always fully reflect all available information about an asset, and it is impossible to consistently outperform the market based on publicly available information. Key principle of the efficient market hypothesis includes information efficiency, random price movement, and no profitable trading strategies. The efficient market hypothesis is commonly categorized into 3 forms. The first one, weak form. The second one, semi-strong. And the last one, strong form efficient market hypothesis. And then we continue to the fifth one, the special topics. In this special topic, we learn about investment fraud, corporate restructuring, leverage buyout, and the last one, we learn about event analysis. What is leverage buyout? A leverage buyout, also known as LBO, is a financial transaction in which a company is acquired using a significant amount of debt to finance the purchase. In an LBO, a group of investors, often including private equity firms, acquires a target company by using a combination of equity, investor capital, and borrowed funds. The key features of a leveraged buyout includes: first, acquisition, then debt financing, number 3, equity investment, number 4, management participation, and number 5, exit strategy. What is event analysis? Event analysis in corporate finance refers to the evaluation of the financial impact of specific event of occurrences on the company's stock price, financial performance, and overall value. These events can include company-specific events, for instance, merger and acquisition, earning announcement, product launches, or broader macroeconomic event, for instance, changes in interest rate, economic indicator, and geopolitical developments. In conclusion, this presentation has provided a comprehensive overview of corporate finance. Remember that learning is an ongoing journey, and I do hope that this session has sparked our curiosity to further explore about the corporate finance topic. Thank you for your attention and engagement throughout this session. See you.